Welcome to the graveyard shift of conferences. As you can see, we are 20 minutes late, but at least we are starting now. And thank you for saving us the time with the introduction, so we don't have to go around the table, so we can delve directly into the questions. We'll start with you, Mr. Bakaya, with your permission, please. So since you have largely gone asset light in your expansion strategy, which are the brands that you're particularly focused on now, and why? And are there any new ones in the making?
Asset light allows you a certain bit more flexibility and agility to do things faster. The brands that you strategically want to develop must be the brands that both owners and consumers want to embrace, must be relevant to the times. So really, it's not so much for a company or an organization to say, this is my brand for the next few years. It's really what's worked well and what is perceived as good value by, in our case, by hotel owners or prospective hotel owners, and was perceived as good value by customers. So in the good old days when we started the company, and I said I work for so-and-so, they said, you work for Sarovar Park, Sarovar Plaza, etc., etc. Those were the, and who are you, what do you do? Today I meet people outside the country on a flight somewhere and I say, I work for Sarovar Hotels. They say, oh, Sarovar Portico. So out of the 142 hotels that we operate today, more than 50% are porticos. And it's a brand that's come to be well accepted in the mid-market, anything from 50, 60 rooms to 150 rooms. Clearly 3-star, 4-star hotels, good value for money, good quality hygiene and housekeeping, good food on the plate and the palate, and the rest of it follows. We don't make huge promises, but we deliver on what we make. So I think our strongest brand going forward, and it's really a mega brand for Sarovar, our bread and butter brand, is Sarovar Portico. The other one where we see a huge opportunity is Golden Tulip. We started off with Golden Tulip on a fresh slate, good 3 or 4 years ago. The brand had some issues. The brand wasn't perceived as either strong or attractive or great value as an international brand. And we started a restructuring program and delivering on the basics. We are somewhere between 15 and 20 hotels already. We have lots in the pipeline. And I think there is good opportunity in an India that's growing in smaller towns for Golden Tulip hotels, which offer you the multinational branding and the systems, a little bit of style and chic and glamour to build those hotels. So for Sarovar, it would be very strongly porticos and Golden Tulips. More importantly, I think it's not so much about brands you build. It's a question of, for me, the biggest question is, am I delivering to my owner after I open my hotel what I promised him when I signed up with him? 30 years ago, that was the case, 200%. 20 years ago, that was the case, we were well ahead of what we promised. 10 years ago, we were still ahead of what we promised. Today, we are not, to be absolutely honest. With all the issues on talent, all the issues on your speed of growth, on how fast you're growing, irrespective of the fact that you restructure your organization and you have different ways to mitigate those issues. I sometimes feel I am not delivering all that we promised the owner when we signed up with them. So not just the development of the brands, I think we focus very strongly now on adding more value, on saying no rather than saying yes if we believe we will not be able to offer the right value proposition. Thank you.
That's really interesting, because I have been a long proponent of the fact that the development team has a big role to play in this, especially when they're advising first-time and second-time owners about what locations, what brands to work. So it's commendable that you're sort of taking that high ground on that when you're deciding on the brands. But how many in total do you have in terms of, how many brands do you have now, sir?
So we have 6 in 3 in Sarovar, 3 in Golden Tulip. We have Sarovar Premier, Portico, and Hometel. We have Royal Tulip, Golden Tulip, Tulip Inn, a couple of others branches off. We manage about a dozen hotels under the Radisson brands. So there's enough and more in the kitty. And I think there's enough available for people to choose from.
Yeah. I don't think Accor would agree with their 56, but still, we are all on our own journey. Moving to you, Deepika, from a very asset-light discussion to a very heavily asset-heavy discussion. So IHCL has been on a zero-debt strategy for a while. Is this true value creation, do you think, for the shareholders? And can you explain to us the thinking behind why you have maintained that position for a while?
Right. So I think you can hear me. So I don't think the strategy is to be zero debt. I don't think that is how we have opened and giving guidance. As Suma just presented before lunch, we've clearly looked at, I think at the core of what we've tried to deliver through these 3 strategic roadmaps that she walked us through is clearly return to shareholders. So we talked about how margin went up from 16% EBITDA margin to 35 as we exited FY25 and a ROCE of 17.5%. What you're referring to as zero debt was really the journey, one of the key outcomes of our transformation where we moved from being net debt and to becoming like net cash positive. So under Accelerate 2030, our guidance has been that we want to remain net cash positive. So there could be a healthy amount of debt. We continue to give a guidance on ROCE, which is to be 20%, which is I think a good stretch target from where we are at 17 today. And just like to share that, as you mentioned, we are a combination of what we call capital heavy and capital light. When we began, we were more on the heavy side. Today, I think capital light would be 60% and capital heavy would be 40%. Going forward, we've even guided the market that we're looking at a capital expenditure of close to 5,000 crores across this next 5 years up to 2030. So that's about 1,000 crores a year. Where are we going to invest this money? This will be across renovations, also a lot under asset management, digital spends, as also select investments. So we have a lot of greenfield projects also on our balance sheet right now, whether you look at metro cities like Mumbai, the Taj Bandstand, and we had given a guidance that we will actually begin construction in before December of 2025, and we're well on course for that. Also a lot of leisure destinations, like IHCL has been known for being a pioneer, so what's coming up are 2 island resorts in Lakshadweep. So we're going to continue with that aspect of the company's legacy, which is to really put many destinations of India on the global tourism map. So this is a healthy amount of capital expenditure we're spending. So the guidance on being net cash positive actually doesn't preclude growth. I mean, growth is fundamental to the organization.
Sort of comes with the fact that you're listed now, so listing brings that challenge. And please don't go too fast because we have a slight edge on the performance over you all, but we don't want to lose that edge. Okay, moving to Bhaskar. Bhaskar, now that you're listed, welcome to the club. I know your life must have changed dramatically from annual conversations to quarter on quarter, and most importantly, growth, and that's why your position becomes that much more important. So how have you structured the development team in the new sort of era where growth is going to be rewarded in terms of clear value at the stock market? And how are you sort of going about that role of yours?
Yes, it's been a different set of 9 months for all of us at the company. We're doing a lot of things with a very different level of energy, and listing was a symbolic milestone in what we've set out to do in the course of the next 5, 10, 15 years. We've always maintained a good, strong pedigree of brands, customer loyalty, identity. I think where we've got clear guidance was the build-up to the listing and the bifurcation of the hotels business into a clean, visible entity. But to be honest, work like this in terms of how the structure that would apply is something that had been going on for the last couple of years. So it's not an overnight transition. We are aware of the massive opportunity this country throws up for new developments. Last count, we were present in over 95 destinations or cities or markets. But I see visibility, and we feel we could do another 95 in the next 10 years. So nothing's really changed from the practice perspective. I think we've left it to corporate and to our investor cell to redefine the listing process, the visibility, and in the process, build additional shareholder value. So not much has changed as yet. We are hoping to unravel a few things in the coming months, and that should give you stronger visibility for ITC Hotels.
Just to finish that question off, how do you see the growth of Fortune in the near future? How focused are you on that segment?
Fortune Hotels has had many senior contributors. I see two of them in this room who've given it brilliant shape over the years. It is our most widely distributed brand. It's done what I would call the heavy lifting in the last 28 years of its existence. And it's only now hitting its true potential of being able to adapt itself to different market requirements. I know at the beginning of the year, there was a lot of euphoria related to tourism destinations, religious tourism, and I think quietly but efficiently, Fortune has already been present in most of these locations. Now we're trying to re-energize that with some of the competitive work that has been done by some of the other brands to refresh it, to give it a new look, to redefine the entire F&B programming that's going in there. And that also has to do with the large shift in the age profile of the Fortune user. Previously, the Fortune guest profile would be early 30s, mid 30s kind of a profile. But today, teenagers are walking into that hotel. Today, early 20s. It is finding favor with educational centers where students are looking at some form of a kind of pocket-friendly lodging solution. So Fortune's actually expanding now, and we'll probably have more coming up in the next few months.
How many did you say you have already operational?
58 as
58.
of yesterday.
Your organization has been the talk of the town since last IHCL. So, tell us, what's the change been like? What's changed, what's not changed for your life in personal and at the organization overall? Has the approach changed? Anything new that we can look forward to? What's happening?
Yeah, so I think the whole shift is, I would say, it's very bold and pretty much needed. After spending almost 2 decades with a very healthy relationship between InterGlobe and Accor, and we did a very good, created a very good base, and the accelerations definitely was needed. Sebastian has been saying this since last 2-3 years, and India is a great focus market for Accor. And this entire new structure is particularly is designed to become more agile, more faster, more sharper. From development perspective, pretty much like for us, we will be looking at high impact projects and expanding the team, getting into the market where we never went. Luxury portfolio is growing so well, right? So we want to tap that advantage, and going forward want to grow that faster. So pretty much like with this, the decision making will be quick. We can decide everything pretty much here in India. So the deal process will get faster, and we are expecting more number of signings going forward.
And any view on what are some of the brands that are likely to come into India soon? Can you talk about that now, or that's a secret?
No, definitely. So we will be getting all the brands in India. So currently we have about 9 brands in India, which is operational, and pretty much we will get all our More brand in India, rather like 2 or 3 projects will be announced soon. So yeah, everything will come in India.
So looks like interesting times ahead. You'll move faster than you used to, or at least at the time when I was there. So hopefully that will change. Manoj, congratulations on your listing too. There are so many people who are being listed of late that you tend to lose count. As a company, were you satisfied with the overall value that you got listed at? Were there any original assumptions that you guys had in mind, and did that play through? Give us some insight into that, please.
Hi, thanks Shwetank for the question, and good afternoon everyone. So, yeah, you're right, so many companies are getting listed in this space, and that's good for the industry because its industry is getting its due recognition in the capital markets. as far as our journey of listing is concerned, I mean, we have been at it for some time, and it took us time because market kind of played a roller coaster during our whole process. Whenever we used to kind of getting closer to the listing, suddenly some tide changed during in the market scenario, and that took us some time. But the whole journey in itself, I'll come to the valuation part later. But first, I want to tell you that the whole journey was very fulfilling in a way, because we met almost like 70 plus investors across all geographies, across all type of investors, long-term funds, short-term hedge funds, private money, everything. And good thing was that the whole investor community is very receptive now to the hospitality space. And they want to take not less but larger exposures. And ours is a modest listing. So we had so much to offer. And most common comment was that we want to take more exposure. So that's good for the industry, that now the entire investor community is looking very positively to this space. And you know, out of 70 that we met, including foreign investors, none of them said, you know, they don't want to enter into this space. So that was a good journey, and we got great kind of response. As far as the valuation and the original assumptions are concerned, of course, we wanted to get a very high valuation, as any company which will go for listing would want. And in spite of our strong parentage, we are coming from 36 years of real estate background. We have delivered over 100 million square feet of space, and our plans are really large and big. What we have done in the last 15 years, building 9 hotels, now we are building over 9 hotels in the next 5 years. So we have a very strong plan in place. But as you must have heard in the earlier panels today, India is still is suffered from the development risk that investor community attached to our whole business model. So whatever plan you present to them, they will discount that because of that development risk, in spite of the strong experience and strong parentage that we have. So yes, based on our current portfolio, we got a very good and very decent valuation. But of course, if you ask me, we get a discounted valuation on our aggressive growth plans. So I'm not satisfied with the valuation, although I would say it's a good, decent, modest valuation. And given the plans that we have, I think if we keep delivering on those plans, I would be satisfied only when I'll be valued, if not more, at least equal to the Chalet multiples that market is giving.
Thank you. That was my next question. So you preempted me, but that is correct, because we are also trying to educate the investors, and they tend to not give you value for what's coming in terms of greenfield, and it's only when it's closer to opening is when you tend to get that valuation. What multiples are you trading at?
So currently it's 17x.
17.
Yes.
All right. Moving on to Vijay Dewan. So thank you for coming. Your acquisition of Fleuries has been one of the areas that we are very excited about, because finally we'll get to learn in the hospitality space from an independent operator in restaurant space. Because it's been a Betanoy for a long time, it's been at Achilles' heel, we have not been very good at F&B. So what are some of the lessons that you can share with us from acquisition of Fleuries that we can sort of take home and learn from?
I thought we are going to be discussing hotels, so I didn't think we are going to be discussing Fleuries. But Fleuries is, it's not being acquired by us. Fleuries is an iconic brand of ours in the confectionery and cafe space. It is a heritage brand, it is an artisanal brand. The recipes, the craftsmanship and the quality has been sort of retained over the years to create great, delicious confections. The F&B space in India, particularly the food service industry in India, is growing at a terrific rate. It is in fact growing at an explosive rate at the moment. It's a business which is about 5.7 lakh crores expected to grow over 10 to 12% over the next 4 to 5 years and hit the mark of about 10 lakh crores. Unfortunately, hospitality players are not in this space. If you look at the BPCL business, which is bars, pubs, clubs, this business and lounges, this business is also growing at the rate of 15%. Currently about 2 lakh crores, expected to cross about 4 lakh crores by about 2030. So this is the space in which we feel there is going to be a lot of value which will be created. Very recently, you would have read, a company which was producing just brownies got a valuation on a turnover of about just 450 crores, got a valuation of about 2,400 crores. So we feel that a lot of value can be created for ourselves as well as for our investors as we go forward. In Fleury's, currently we have about 102 outlets across India, particularly in West Bengal and Maharashtra. Today we have almost 20 outlets in Mumbai between Kolaba and Malad. So this business is a 30% CAGR growth business for us, and I strongly feel that it's going to create enormous value for ourselves as well as for our shareholders as we go forward. Earlier I thought we are going to be discussing hotels, so a little bit about Park Hotels. We also got listed last year in February last year. We got overwhelming response. Our issue got subscribed over 60 times. And it's very good for the industry. The industry has raised over the last 2.5 years, roughly about 9,050 crores to be precise. And we have raised about 1,000 crores in the public issue last February. We have at the moment 35 hotels with 2,390 keys. We have top assets in top locations. We have 1.5 million square feet of our own hotels in top locations. And we plan to construct another 1.5 million square feet of space over the next 5 years. We have a capital outlay of about 1,800 crores over the next 5 years. The most important thing is that we have taken a decision that our company is going to be debt-free all the way in terms of our development cycle. We are currently net cash positive, and we plan to be net cash positive in this entire journey over 5 years, doubling our space from 1.5 million square feet to 3 million square feet as we go forward.
Sir, I did have some hospitality questions for you, but since you've delved into it straight away, why don't we do it in reverse order this time, and we'll start from sir. So your Park Preferred program is progressing quite well, and can you give us some more color on it, and in terms of what's the current loyalty membership base and what are some of the works that you're putting in place to sort of push it forward?
So loyalty is very critical to business. First, talking about percentage of repeat business for us. We are proud to say that our percentage of repeat business is in the range of 28 to 30%. And this percentage of repeat business for us only creates high occupancy for us. For the last 4 to 5 years, we have been recording occupancy of over 92% across our hotel. In fact, for our hotel in Calcutta, we have been doing 99 to 100% occupancy over the last 5 years. Including the COVID years, we had India's highest occupancy of 67 and 79%. And this is largely due to the fact that our customers believe in us, that they love us and they love our product. So Park is a very highly differentiated product. Firstly, it pioneered the concept of boutique hotels in India. Its differentiation comes from design and art. It comes from entertainment and in creating unique service experiences. entertainment in our business is used to create customer value. Typically, hotels create customer value on the basis of quality, experiences, or services. Park is the only company at the moment which believes in creating a very different atmosphere for its customers and uses entertainment to create experience, customer value. Critical, it is our hotels are always, vibrant, they are energetic, they are always on the move and they are always buzzing. And this is the key differentiation. We have a very strong loyalty program which supports this repeat customer base. Currently, we have about 4 lakh members. It is a 3-tier membership of gold, platinum, and black. And of course, it helps us in terms of driving our, firstly, the loyalty helps us in securing our high occupancy, and then of course, the ARRs are always definitely higher through loyal customers, which is in the range of 8 to 10% higher than we get from other sources of business.
Thank you. 92% is remarkable, ladies and gentlemen. I think unheard of in the industry. So it is a fantastic achievement. Manoj, back to you. You all have announced a massive pipeline of hotels, and hotels in the asset-heavy space we know requires a lot of capital. What's your plan for that, and what's the source of funds going to be? How are you seeing this?
Yeah, so as I said earlier, I mean, we have quite an aggressive growth pipeline. We currently have 9 operational hotels, some 1,600 odd keys, and we have taken on 9 more hotels with another 1,600 keys to be delivered over the next 5 years. Of course, in addition to the development challenges that we will have to, take on, financing is one very crucial aspect. And thankfully, with the IPO that we have just concluded, now we have gone debt-free kind of a scenario. So we have repaid all our debt because we knew that this upcoming pipeline will require debt, and we will take on debt as and when it is required now as we move along with the construction of these 9 hotels. So what we have planned for these 9 hotels at least, with the cash flow on the construction milestones that we have planned out, and with the debt that we can generate on the current operational hotels as well as project debt on the project level, we are fine with internal accruals and the debt to be in a healthy kind of situation, because as we are going along year on year, we will be increasing our EBITDA. So even at the peak debt level, we will be at a very healthy EBITDA to debt ratio. So these 9 hotels are already kind of planned in terms of the financial funding. But the most important part is that, okay, these 9 are planned, but we will not stop at 9, because 9, they are already on the cards now. So we'll be looking for more development opportunities. We'll keep adding more hotels to our portfolio, and financing for that will become important. So there I can tell you, we have been in discussion with various financial institutions and alternative capital source institutions. And again, I would like to, emphasize on that point that that not only the conventional banks and the conventional kind of project loans, which was available for the hospitality industry earlier, now even the newer type of financial, the more modern method of financial structuring, alternative money, bridge capital, everything. So I am now finding out that innovative capital is also getting into the hospitality space, and they are ready to fund at the asset level. Private money, private equity money is ready to take exposure on the asset level, on the project level. So that's a good sign for the industry. I mean, financial limitation will not remain that kind of limitation going further, and that will help not only us but the entire industry. So that's a good sign on the financial funding aspect.
Just for my education, at what debt levels to EBITDA are you comfortable?
We can talk about that after the
Okay. All right. If you say so. Moving back to you, Anirudh. Your company just acquired Trebo. What was the thinking behind it? And Can you give us some color on the valuations, the principles that were applied? Because there's nothing much that was said in the public domain, if you can share it.
No, I think valuation and the structure probably I cannot comment on, but definitely like if you see the strategic value in this deal, for both the parties. So with this investment, we become the largest shareholder in Tribo, right? Both together Interglobe and Accor. Though it is not the majority stake, but there is a tremendous opportunity for both of us to leverage technology and operating capabilities of Tribo. From development perspective, it is a master license agreement for Ibis and Mercure brand. So they will be growing these brands in most of the market. And we will be concentrating more on the Novotel upward and the larger hotels. So there are a lot of synergies there, and I hope the Sid is having the session next one. He will give more detail about it.
So are you saying the Tribo development team will be responsible for Novotel and Ibis expansion?
That's correct. So they will be managing, they will be doing the deals, and they will be managing those hotels.
And that team reports into you?
No. They will be separate team altogether. And see, you need to think about it that in tier 3, tier 4 market specifically, 60 room, 70 room, 100 room hotel, we are typically saying no. I used to get at least like 20, 25 opportunities on daily basis in that particular segment, and we just say no, right? And then Sid himself, he's having about 30 odd developers in his team. So there will be exponential growth in those kind of deal. We can tap in and we can brand it as a Mercure or Ibises.
Sure, thanks. Back to you, Bhaskar. How's the demerger from the mothership been like? Do you now have more pressure on return on capital employed, or is it the same old beautiful days as before?
The last 9 months is a journey that nobody in the company had been through previously. While we may have statistic reporting on year, but it's a look forward direction. Quite honestly, you use the word mothership. Yes, ITC equipped our entire team to start looking in the rear view mirror a lot earlier. And so we are picking pace. We are understanding what the external markets are behaving like. There is very minimal or probably negligible dependence on the mothership at this point of time. We are going out there solo. All our subsidiary companies have come into one fold. So yes, it's a new phase. We will be closing our first independent year at the end of this financial year. And then from there on, we will just push for growth.
So now you earn and burn on your own, which is good.
Right.
It's an education. Deepika, we spoke about zero debt before this, but you obviously have a super strong balance sheet and you're in a great position. And IHCL just made a couple of big acquisitions. Is that going to be the way forward for you all, and how do you guys see it?
I think just before that, I was just telling Mr. Bakaya, it's great to see that every alternate chair almost is a listed company, and somewhere I think all of us collectively can take pride that hospitality company is today a large cap company. I don't think that has happened before, and with IHCL breaking into a large cap, I think it augurs very well for everybody who's looking to, enter this space and raise capital. So it's good to be a front runner there. With respect to these acquisitions, so we've clearly set ourselves a goal of 700 hotel portfolio. Within that, our brandscape is very clear today. We look at it in terms of there are a couple of our brands that we define as growth brands that will really be focusing on scale. So on the upscale, we have the brand Gateway, which is our full service brand in the upscale segment, something that we just relaunched last year, and it's now a portfolio of 40. Then we will have Tree of Life, which is focused on the leisure segment in the upscale. So that's another brand. And then we'll have in the mid-scale Ginger. So these three together will be what we call the growth brands, and they will be focused on really rapid scale. And that's where these acquisition opportunities fall in, where we see that these are going to be accretive additions to the portfolio. We will definitely look at that, because Ginger is now, by itself as a brand, it is 74 operating hotels. It has a pipeline of about 30 keys, but you get a suitable opportunity it helps you to actually achieve double the scale in a much shorter time. So here's where we will see larger such opportunities, but we will look at it in the right form, right way of infusing capital and also having control. The other side is to consolidate our presence in the luxury segment with the Taj and Claridge's collection. We will see a lot more on Claridge's collection over the next few months. And then Vivanta in what we define as the upscale lifestyle brand, and Selections, which for us is a platform because the country today has so many standalone unique resorts, and we see that you can't apply a cookie cutter brand there. So this is how we look at our set of brands. And just to wrap that up, I think we will, besides what we traditionally understand as STR segmentation, we're also very active in the homestay space, which today is a 300 bungalow portfolio for us. About half of that is in operations and half is in the pipeline. So I think a lot of acquisition opportunities, evaluation for sure in the growth brand space.
Deepika, I must compliment IHCL, you know, for achieving market cap of over 1 lakh of crores, 1,10,000 crores to be precise on this day. More importantly, we can now see that one Indian company at least is among the 10 top companies by market cap in the world, and that really requires a thunderous applause.
I was just about to say it helps to be in the chair when all of us combined is your chair alone, so it does help when you're part of that company and legacy. I think we have time for one final question and maybe one or two from the audience. This one's for you, Mr. Bakaya. Although it's been a while, what were some of the key learnings you've had from Louvre and Jinjiang ownership at different points in time? And do they look at the business differently from how we look at it, or whatever enlightenment you can give us?
Just to clarify, first of all, we have no relationship with Jinjiang Hotels. So it's purely Louvre. Louvre is majority shareholder in Sarovar since 2017, and it's been a fantastic journey. The benefits to both sides are abundantly clear. That's why both sides went in for the partnership. From the Louvre point of view, they have a fantastic footprint in India. It's a story that was good 8 years ago, and that's only gotten better year after year after year. And it's a phenomenal story for Louvre in this part of the world. For us, we benefit dramatically from the technology that comes in with the group, from from processes and e-learning to a central reservation system to global distribution systems and to loyalty programs, etc., and more to come in the future. So technology is a big thing. They have a more global view on what's going on in different parts of the world and how each part can benefit from the others. So it's a great plus from both sides. It's been a symbiotic relationship that I think both of us are happy with and both of us are well and truly in love with.
No, you clearly brought an understanding of the Indian landscape that they wouldn't have had if they hadn't had you. So clearly that was the advantage that you put on the table. So thank you for that. We have time for a couple of questions from the audience if anybody wants to ask. We are all fair game here, so anybody? Thank you so much. I must end with an apology. Bhuvnesh's team put together a list of questions. We threw it out of the window and I asked the questions that I wanted to ask and I wanted the answers to. So I took the liberty of that because I was asked to moderate this panel. So apologies if we didn't get to the real meat of the discussion, but this is what was in my head as the queries I wanted to ask this eclectic panel. Thank you so much for being here and thank you all.